Couple of days before, I got a call from one of our prospective clients whom we got through our clientele as a referral. He was asking us the possibilities of tax planning, especially at a one tax we do tax planning, and he wanted to know about what is tax-free income planning that we do at a one tax. And he wanted to also understand how he could take advantage of the existing tax reforms. Friends, today I would like to give some idea about what this entire tax reform means and how we can take advantage of tax reforms as well as tax planning. This current tax reform is, when I say it is meant for the smart people, or we say the smartest people in the United States, to convert their income from taxable to tax-free zones, or tax deferred to tax-free zones. When we say both taxable and tax deferred to tax-free zones. How is it possible? I'm going to explain a little bit. Within this current tax system, you can see that when you classify the people that are employees, there are specialists, there are business people, there are investors. Who is hit at a maximum tax rate is all the specialists. When you talk about specialists, they pay 41% of tax, though the tax rate is dropped down to 37%. 37 plus 3.8%, 78% is the net investment tax. When it adds up, it's going to be like 41%. The employees on an average, up to the extent of like $315,000, married filing joint status pays at the rate of 24%. Business people, they are in the lowest tax bracket. They pay only 21%. If somebody forms a C corporation and pays taxes, his tax bracket is going to be at a maximum rate of 21%. When we talk about investors, they are the privileged class in the society. Investors pay no tax up to the extent of $77,000 when they find married filing joint status. There is another category of people, they are called, investors in the higher bracket. That means they don't pay taxes. At the same time, if they pay, what they will do, they need to pay at the rate of like 15% up to $480,000. So the movement of income between employee to what you call an investor category or through a business, people will get benefit. So this is all about the tax reform we can see, and who takes advantage of the tax reform matters most at this point. And why we have to do that? There are a couple of things. Let us say that our tax deferred income, which we grow, will be eligible for us to take after retirement. In order to take $100,000 after retirement, we have to say it is 30%, roughly 24% in tax bracket plus, another 6% state income tax. In the state of Texas, there's no state income tax, but in other states you need to pay state income tax. So when you have to withdraw money, in order to withdraw $100,000, you need to withdraw $142,000 and pay tax on, tax at the rate of 30%. So in order to have cash in hand $100,000, you need to withdraw $142,000. This can soon deplete your income unless until you grow this money tax-free through tax planning. So let's look into the scenario, what is going to happen in future. This tax planning is, effectively from 2018 to 2026 going to give all the tax benefit, and afterwards the tax system is going to be in real trouble. Because let's look into some of the things. The government spends most of its money on Social Security, Medicare, Medicaid, and interest against public debt. As of 2017, the government spends almost 76 cents against what you call a dollar receipt. So if the government spends 76 cents, means the government is left with 24 cents to spend on other schemes, including other welfare schemes. So Social Security, Medicare, Medicaid, and the interest against national debt consumes the entire economy. And by the year 2020, it is estimated that instead of $76, it is going to be 92 cents against a dollar. So what is going to happen? Government has to increase tax. Otherwise, they cannot fund Social Security and Medicare. So let us go back to the history of Social Security and Medicare. When the Social Security was first introduced in the United States by President Roosevelt. This was introduced in assumption to offset unemployment, and at the same time, it was an assumption that people live up to the age of 62 and retire at the age of 65. And there were 42 people contributing to Social Security benefits when one person enjoys the benefit. That is going to change. As of 2017, it's only 3 people contributing to this fund. This reduction of the Social Security contributors can create a very big problem in the economy. Government has been spending almost $945 billion towards Social Security. And this is not the correct estimate. It can be much more. What happens? So this Social Security system invented with the assumption of the birth rate as well as the life expectancy. The life expectancy increased rapidly at this point, where instead of 65, instead of 62, people started living almost 85 years in the United States as a for record. So Social Security system is going to be, out of place. It cannot survive, after 2020. The entire money is going to be depleted. And it is estimated that by the year 2035, Social Security system is going to suffer from a $1.9 trillion debt. Okay, let's take another example of Medicare. Medicare was first introduced by Lyndon B. Johnson in the year 1965. That was meant for people aged 65 and above to have, insurance benefit regardless of income and disease condition. And it is also presumed Medicare trust fund is going to be depleted by the year 2030. Government has been spending tons of money, $595 billion every year on this Medicare. So Social Security, Medicare and state-run Medicaid program, including national debt, is going to be toppling at this time. It is going, by the year 2020, it is going to be like 92 cents per dollar. So how can this economy survive without increasing the tax system? So let's look into the tax scenarios. There are situations, there are years, like the tax system. When you refer to tax system in the United States, it was first introduced in 1913. We had 1% of tax. And from 1913 to 1943, the tax rate went up from 1% to 94%. Let's say who were the people who had to pay that 94%. Let me take one example. That is Ronald Reagan, who was a contemporary at that time. Ronald Reagan was a film producer, turned out to be a politician. So Ronald Reagan, who used to live in California, at the time he had to pay a 94% tax, which does not include the California tax. California tax itself is 6%. So what is going to be left with? So what he did, he split income on accrual basis for a couple of years, and he was less than the threshold of $200,000. So that was the criteria. Like anybody with the income exceeding $200,000 was subjected to 95% tax, and which it does not include California tax. With the California tax, it was going to be likely 100%. So he has been left with no money after making $200,000. That was the scenario. So then let us go back to 1960 to 1963 period. 1960 to 1963 period, the tax rate in the United States was, 20% for, lower income group, middle income like 66%, and higher income like 71%. So it indicates that the tax system in the United States pretty much stayed greater than 70%. So in order to deal with the government spending, which is going to be likely 92 cents against $1, the government has to increase the tax system. So it is going to happen. So the tax sale that you see through this terms tax reform is just for what you call this 8 years. It is going to be over by 2026. So that is all about the tax reform, and how one can benefit, can be benefited out of this tax reform is to do through tax planning. Tax planning in the sense that what you can do, you can move your income, taxable income and tax deferred income, to tax-free zones. So when you do, what happens? Your income grows tax-free. You do not know that Social Security income is taxable in the United States. When in the year 1983, Social Security's income was taxable at the rate of like 50%. Means 50% of Social Security income was taxable at the ordinary rate. So, or the current income tax bracket. So, in the year 1993, when Clinton became the prime minister, the president, what he did, he raised it to from 50% of social income to 85%. Now, anybody who makes more than $32,000 through Social Security income has to pay 50% of 50% of that income is taxable. Like income between 32,000 to 44,000 of a Social Security drawing has to pay tax on 50% of his income. Any income exceed, that means it's a married filing joint status. I'm always referring to married filing joint status. So anybody with income greater than $44,000 has to pay tax on 85% of his income. So unless you do planning, what happens once you retire, or when you start taking Social Security and retirement fund, what happens? You need to pay tax on your Social Security as well. People believe that, people are under the impression that we don't have to pay tax on Social Security income. That is not right. So what we can do, we can funnel this taxable and tax deferred income or the savings that you have into a tax-free zone. So how we do that? We have multiple options. When we convert this income, the first option, you can transfer it through Roth IRA. The second option, you can transfer it through life insurance retirement plans. How does it work? Life insurance, irrevocable life insurance trust. We have to create multiple trusts that can move your income from the taxable and tax deferred zone to tax-free zone. It requires the role of legitimate attorney, lawyers, tax attorneys, and estate planning attorneys. So we work with the tax planning and estate planning attorneys to help clients move their income from taxable as well as tax deferred to tax-free income zone. Let's look into this scenario, how it works. So when you create an irrevocable trust, you move your income from your taxable source of income to a trust, and the trust is set up to help you with your beneficiaries. So when you are not directly benefiting out of the trust, then you can take tax deduction based on the contributions that you do for your future purpose, which will be connected to your estate. So your estate is now married filing joint like $22 million. This is not going to stay after 2026. The chances that the Democrats will come into power or the Republicans will bring it down in order to make more people pay tax on it. So the 40% estate tax now dropped it to 35%. It can go to any extent. It can further go to 4 million, further go to 40%, or they can bring the bracket down to like a less than 5 million or 5.5, 5.48. That was what it was happening. So when we help with our clients, what we do, we help with our clients to move their income from taxable to taxable and tax deferred sources to tax free source. In order to help with you on this strategy, please give us a call. You can reach us at any time. We are right there to help you with our tax planning experts as well as attorneys, to anyone who is interested in taking advantage of the tax reform, which is going to be over by the year 2026. Thank you.